Welcome to Avenue's Q1 podcast based on our quarterly letter for 2025. I think that an awful lot has happened, just in the last couple of weeks since the quarter. And I think we were so busy that we didn't get to this until obviously right now. And we're in the beginning of May. And really to give everybody an update. And it's really not talking about the first quarter now because we lived a lifetime just in the last 4 weeks.
It seems like a lifetime. Yeah, it's been amazing the last month, I guess. The markets have been so volatile. And the information or the misinformation or the deal making or the tariffs on, the tariffs off, the global markets ending, and then there's this huge rally. It's caused so much distortion. Just as a classic portfolio manager, as a job itself, it's made this job very hard because we tend to focus on the fundamentals and the analytics of not only our own portfolios, but when you look through the markets, you try to get at least a forecast or an idea of what you want to do. So we've always talked at Avenue, we've always tried to be kind of battle tested when it comes to this, and maybe we could spend a couple moments and just kind of talk about just what we have seen and what we've done, and kind of expand on what should happen.
Well, I'm going to throw it back to you again, but I'd say the way we even opened the quarterly letter is saying we were prepared for this because Avenue's strategy sort of handles all this. Yeah. And I would also say, quite often I find myself saying that you can't really tell that Avenue is doing anything different on a day-to-day basis. And the market goes up and down, our Avenue portfolio goes up and down. But I think it's really in this one period of time, just how stark it was going through and just like going, oh, this world is becoming very uncertain. Yeah. And then seeing how the Avenue portfolio performed, with what happened over the last couple of weeks.
Yeah, and every manager always hates that uncertainty, whether it's us or anyone throughout the world. We kind of live by that certainty and certain rules and consistencies of the market. And that certainly doesn't help when you get the U.S. administration all over the place. But maybe we can kind of go into how we, as you mentioned, you would think there was a lot to be done, but in a sense, our portfolio was pretty consistent. And, maybe you could talk about, I guess, the components of how we look at the construction of portfolios and, for that matter, the construction of the equity portfolio.
Well, I think that there wasn't any panic when we were going through it. The worst day in mid-April when we were down, the market was down 20% and we were flat. We were up a bit on the year. Our portfolio came off a bit. And then he said we again tried to take through in the quarterly letter, when we're thinking about the portfolio, it's just not a collection of stocks that we have in there. These are all business that we like. It's very carefully constructed. We certainly right now have a component of cash. We think there's still going to be ongoing in various parts of the market opportunities where we can find things. So there's always a cash component. Gold that we've been invested, for 21 years now, always a component in gold. But man, now gold has become a thing. So the 10% is in gold doing well.
And then just maybe expand on that, you don't have to go into all the securities, but we don't own gold. We own gold companies. So maybe
gold. That's a good point. I shouldn't say that because cash is even then when we say cash means actually treasury bills. You're still getting a rate of return on your treasury bill. Gold, we don't own things. We don't own, barrels of oil. We don't own, sort of ingots of gold or commodities. We'll own a business. So the concept is if you own a gold mining company, it's a depleting business, but we have to own a very special gold companies that we think at the end of the year, they'll have more gold than they have at the beginning of the year. And again, that's always a challenge, but we've been successful at it now. And so very specific gold investments. We have royalties, and we're in another one operation where we're building a gold mine in Australia. Yeah. But very specific exposure, cash, gold. And then we always have another round, it's 20 to 25% currently in Canadian dividend paying stocks. And then these are extraordinary anomaly right now where they're just really throwing off a ton of money. Historically, dividend stocks would have been 2-3% dividends. We're able to get over a 6% dividend.
Yeah, the Canadian dividend that whole sector has almost been just forgotten worldwide. And there is a lot of opportunities that we are finding in the Canadian space.
Yeah, and it's not being so worried. And if the stocks can obviously come off always, in one of these markets, they oddly held in this time because it was a running away from growth stocks and people were hiding in these sort of, more conservative dividend paying stocks. So were called defensive through this last couple weeks. But then we're able to collect the dividends. The dividend stocks are defensive. And so that was actually 45% of the portfolio was in cash, gold, and dividend stocks. And really the exposure we had in the equity side, and we still call those really high quality companies, all making high rates of return on their businesses. We sort of always keeping that 3 to 5 year time horizon on the business. It'll be a much better business in that time horizon. And we really don't get panicked when we have one of those sort of moves.
And it seems like a lot of the investments we make they're not exclusively, but a lot of them are kind of defensive in nature or have, in a sense, a bit of a moat around them, which you kind of always want in good times and bad.
Oh, 100%. And I think that's it's that type of business just being really consistently profitable business. And then going back, and we actually haven't said the tariff word yet, because this is really just this tariff chaos that we had to go through, and just coming in the morning, what's happening, what's on, what's being taken out, and really understanding our businesses where it was completely discussed. This new president of the United States, Donald Trump, won in November, had talked about tariffs. We went through the portfolio in November. What is the type of company that will get hit? An obvious one in Canada, Magna Auto Parts. Is it going to get hit? Got really hit. So those companies are still in the crosshairs of a cross-border tariff battle, but there's an awful lot of businesses that aren't impacted at all. And so we went and did that, almost 6 months ago.
Right.
And so when the tariffs really hit, it was very interesting to say that the market wasn't ready or didn't expect that, this is really going to happen. And then on the day one, the market positioning was offside.
Yeah, it's not that we intended this, but it almost seems like with the portfolio, or with our Canadian positions and our U.S. positions, they're almost very domestic led. There's not much cross-border activity other than maybe CP Rail, whereas they're all insulated by the T word, the tariff word, and they all kind of run organically or run consistently in their domestic pocket, and you don't really have to worry about that tariff and the leverage from what happens if global trading tightens.
Yeah. So anyway, we just want to bring that up. It was extraordinary, couple days to go through. And again, this was the example, the stock market, the leading big technology companies in the US, they were down 30% at one point. And again, our Avenue portfolio was basically flat. And we were quite enthusiastic about the things that we're seeing and what we're able and how our businesses are doing. So I'm just going to go now, just give an update because, now it seems like we're through it. Now that this is just in the last couple of weeks, our portfolio is now up on the year. The market, they've rallied back. A couple of things like the Dow Jones is still down, but the S&P is almost flat and the TSX is now flat on the year. And it's in the Canadian market. But I would say that the interesting thing, we'll just run through with just this handful of items that we're looking at, because I would still say we're going to be cautious because of all that. There are still, tariffs are one headwind, but we still have another one. But I think it's just throwing back to, we still have this incredible budget deficit, no matter how much they think they're cutting of the budget in the US, there's no cuts, it seems.
Yeah, it's truly the elephant in the room. And from looking at it from afar, and actually personally living through the Canadian debt crisis back in the 90s, you get your back up and see a lot of similar patterns. And when you listen to all the talking heads on the news outlets, there's not one spoken word about, like realistically cutting spending or increasing taxes. Because really in the end, as much posturing there is, whatever political spectrum you have, it really comes down to, because the numbers are so poor in the US, we're about to hit probably, and I'm probably being conservative, probably a $2 trillion deficit. And that's going to be really problematic because we're reaching, I won't say the edge of the abyss, but we're getting closer every day. And they're not understanding the ramifications when you have, as we speak, we're seeing the long end of the yield curve in 10 years and out, which is more or less considered the long end of the yield curve. It's reaching new high yields. So
this is where you just switch from a stock market hat to a bond market hat. But let's make sure we make that distinction on that. So
and you remember, this is, whether you like it or not, the bond world is far more, is so much larger than the equity world. And in the end, the taskmaster to the equity markets is right now the bond market. Because if you do see, as I've called, the long end of the yield curve becoming unanchored, meaning there is so much supply about to come through the system that it's going to be tenuous for refinancing, not only at the government level, but at the corporate level. I'm specifically talking more on the US side. On the Canadian side, the dynamics are slightly different. We will be affected quite a bit by the US curve, but we're in our own little kind of pocket in the sense that we don't have, just to put it in perspective, the US is going to probably run in these good times a 9% deficit to GDP. And if you just can recall, the European Union had this hard rule that they can't go beyond 3% deficit to GDP. And as much as we scream about our Canadian government spending too much, we're still in the realm of 1% to 2%. So on a relative perspective, at the federal government level, we're still in a very strong position relative to all the G7 nations. But the US is another matter. And the problem is they haven't found religion yet. I guess that's what I would call it. And this will affect not only risk assets, it'll affect the equity premium. It's going to affect society as a whole, because in the end, you could watch hours and hours of the budget talks in the US, but it really comes down, are you taxing or are you cutting spending? It just they're at that time frame that growth will not help them. Juicing, liquidity and the pumping of the government since COVID, there's been so much fiscal spending that you have to remember that helped the equity market and the global economies quite a bit. But now we're starting to see the tightening. Whether you like it or not, it is starting to tighten. The pipes are starting to clog up.
So I'm just going to go on that. So we'll finish up on that note, and I'll just summarize it. So what those two pieces they do, switching to the bond market, worrying about the bond market. This is something that we're concerned that if interest rates continue to go up, which we would expect because of this dynamic, that is a negative. So we should be cautious. But still coming back to the initial point, it has not hit yet. The budget deficit money, this $2 trillion is going into the system, and the financial system is flush with money, and the stock market can keep going up as long as that case. And everything you've brought there is that, but once this happens,
yes,
we've got we do have to start being nervous, because it's something that cannot go on.
And I would say every day I think about that. And I think eventually, and it's not here yet, and there's still liquidity, like you said, but you're starting to see the high yield market in the US, and I call really high yield like triple C's, which is like almost default. Like it's the lowest quality bond out there. Spreads are starting to widen from their relative investment grade bonds. So that's kind of a canary in the coal mine. This normally wouldn't be a thing, but we're getting to such large numbers that eventually mathematics starts taking over. Just interest expense on the U.S. market is, I believe it's almost as big as defense spending right now. So,
I'll just round up. So this is still the reason why we would like to be cautious. It still doesn't take away from the fact that all that it's building in caution into the expectations. Still doesn't mean we're not owning good companies.
No,
And even if you have problems that there's scenarios where you're depreciating the currency or these other things, the answer we still come out with all the time is you still have to be invested. And your money has to be invested, and your money to grow your capital over time. And sometimes you always think you're making money, but sometimes you're also saying that the money is being depreciated, and you're trying to maintain the purchasing power of your money.
And you would go back to the portfolio, and you would feel that, I feel that the portfolio is good for all seasons almost. So we will be able to deal with this issue on what we own, just because of the somewhat conservative and the fundamentals of each company. Doesn't mean that we don't get hit as well, but just as you had mentioned, the S&P or stock market was down 15 to 20%, and we saw our portfolio pretty flat, which was a win in a sense during that whole sell-off in April.
Yeah, there's always something we can find.
Yeah.
And also, it's really when we're saying, even though I always just want to emphasize that the thing you were talking about, it sounds like it's negative.
Yeah.
It's actually an opportunity.
Yeah.
We're in the business of buying businesses, owning businesses,
for
reinvesting investors for long term. So when everything's super expensive and the stock market's going to the moon, and maybe that feels great, it's actually not great, because we're in the business of constantly trying to compound our money, which means it's an opportunity when we get these
That's exactly it.
points when the stocks come off.
Yeah.
Okay, let's leave it on that.
Okay, thanks.
Yeah.